India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Mangalam. Guys, hi, good morning.
Good morning. Day two. We have the band of boys.
And it's a little cooler here in Mumbai. I think this morning, a little cooler than normal. I know for a Delhi boy, this isn't cool. But for Mumbai standards, we're getting into the Mumbai winters.
And I thought the haze is also a little better this morning.
Yeah.
I mean, otherwise it was bad. I mean, by Bombay standards. Delhi, of course, is catastrophic. But here in Mumbai, it was getting a lot, very bad. But I think this morning, I stepped out. It was looking a little better.
You know, better weather and hopefully better times for the markets.
Some of the people were saying that, running on the road in Bombay is better than doing yoga inside your house in Delhi. That's the difference between the air quality index between the two cities.
Delhi is absolutely crazy what's happening. But well, we see that every year, and every year people complain for that. For those sort of few months, and then of course it's unfortunately back to usual in that sense. Hopefully, authorities take charge, get a fix of things. Well, that's a conversation for another time. But let's just start by telling you what you need to know as far as markets are concerned, because it's looking a little better. I mean, and this is largely on the back of what we've seen overnight, because 2 days in a row, the markets in the US were coming off. NASDAQ had lost about 3%. Last night, a little bit of a lift, 0.5% on the NASDAQ. S&P about 0.4% higher. So risk sentiment is improved. By the way, bond markets traded better. So yields came off about 2 basis points to about 4.42. Dollar index has cooled off about 0.5%. And I suspect it's largely positioning related. Because, I think if you go back and look at the last fortnight or so, pretty much every day, the dollar index has moved up by 0.2, between 0.25% and about 0.5% or so. So a little bit of cooling off is what we've seen as far as the dollar index is concerned. Post-Trump, we've got very little data in terms of how general economic confidence, etc., in the US is. We got that ISM manufacturing number. This week, we'll also get the PMI numbers, flash PMI numbers. But you had one indicator last night, NAHB builder confidence, that beat expectations. It hit a 7-month high. So this is, just immediately post-Trump. We'll, of course, as I said, get more data this week. Oil prices jumped 3.5%, 73 plus. Gold prices came up as well, back above $2,600. There is, of course, some development in the Middle East, which we can talk about. But I think there is another important development, which may also be kind of the common reason why both did well. So the Biden administration over the weekend actually authorized the use of, and these are news reports, authorized the use of long-range missiles by Ukraine. Russia has so far maintained that this is the red line. If Ukraine is given long-range missiles capable of striking deep into Ukraine, Russia will consider that it's at war with NATO. And I think this is something which was, unsettling, a bit of a disquiet, and you had gold which went up, and I think, of course, oil prices which went up as well. As I said, there was also that Middle East news flow, Israel striking, in Beirut, and of course, that's a developing situation as well. But I thought this was important to highlight. Lots of headlines suggesting more sort of likely Trump appointments. There are some news reports about who the likely Treasury Secretary is going to be, but no confirmation. So we'll wait for that. How are things set up in terms of levels? If the market, after coming off, and we have come off quite a bit, has got to come up a little bit, you've got to start to look at what it needs to get past. So then 23,748, 23,750 roughly becomes the first sort of resistance line, which the market needs to get above for things to improve somewhat. Supports come in at about 23,189. We've been putting out the same number last couple of days. That's a 61.8% retracement of the full rally from the June 4th lows and to the all-time highs. So let's see. If some gains are able to sustain. Bank Nifty yesterday traded within. It was an inside day for the Nifty Bank. We traded within Thursday's range On the way up for the Nifty Bank, the level to take out is 50,828. We left off at about 53.63. It's about 1.5% away. On the downside, the recent low is 49,904. And then, of course, for the Nifty Bank as well, you look at the 61.8% retracement. So that's the setup. I mean, also remember here locally in India, tomorrow is a holiday because of the account of voting in Maharashtra. So markets are going to not be trading. Well, global markets are going to be trading. So there is that element to throw in as well. GIFT Nifty, I think, is indicating a slightly higher start. I mean, it's not how you start, it's how you close, especially after what we've seen over the last, 1 month, 1.5 months or so. So 70 points higher, but at least some green to begin the day with. Guys.
Absolutely. So I was just looking at the cues every day, and the more things are different, the more they turn out to be the same. And every time after the sell-off that we see, we hope that, there is some sort of recovery coming by. And if there is a short covering bounce, chances are that it may be, more hope than anything else. So that's something that we'll most definitely keep an eye out on. The Nifty has declined for 8 straight sessions. In the last 8 sessions itself, it's lost about 1,000 points. So if you look at it from a point-to-point basis, November 6th, the Nifty was 24,484. The bulls were hoping that the Nifty goes ahead and crosses that 24,500 mark. Well, 8 days later, you have the Nifty at 23,454. Now the bulls are hoping that the Nifty crosses that 23,500 mark and stays above that as well, the 200-day moving average that we're talking about. The index to track today will, of course, be the IT index. Why do I say that? Because yesterday was the key drag on the frontline indices, and that's because of the big cut that we've seen in the NASDAQ over the last few trading sessions. But yesterday, the NASDAQ ended about 0.6% higher, snapped a 4-day losing streak. So to that extent, do we see some relief coming in for the IT stocks or not is something we'll watch out for. The FIS selling, we've been talking about that, right? Now that's been reducing over the last few trading sessions. Yesterday's selling was just around 1,400 odd crores, and the DII buying is outpacing that for at least the last 3 trading sessions. If you look at the net flows as well, for 3 trading sessions, they've been in positive. Yesterday it was close to 1,000 odd crores as well. Interestingly, in index futures, the FIs yesterday sold the Nifty 275 crores, not much incremental selling, but the Nifty Bank, which was outperforming, saw some purchase, so we'll keep an eye out on that one. And the broad range to watch out for would be obviously yesterday's low of 23,350 and the 200-day moving average of 23,565 itself. The one stock I'll be watching out for will be Indian Hotels. In the last 8 sessions, when the Nifty was down 1,000 points, this stock is up 10%. It's got the capital markets day today, and usually the company lists out its long-term vision in the capital markets day. So we'll keep an eye out on that. And from a short term as well, it's entering seasonally strong quarter. So we'll watch out for that one stock. Nigel.
Well, that's right. The hope is that the Nifty IT stocks, they do well in today's trading session, because yesterday they got slam dunk and the Nifty Bank actually has been doing well. But if you had to pick a day, maybe today could be the day, and the bulls could look to fight back today. The reason I say that is because, overnight we have the dollar index. After a while, it was down close to around 0.5%, and that's something that you're waiting for. So a weaker dollar is something that you look forward to. And in terms of FI selling, they continue to sell. But the selling that we saw yesterday was half of the average that we've seen in November so far. So normally they're selling more than 3,000 crores. Yesterday it was sub 1,500 crores. So both those 2 data points, the bulls will want to, cling on to those data points. What are the FIs doing in yesterday's trading session? Well, they added more longs and shorts. So that's surprising. After a while, we've seen that close to around 5,000 long contracts is what they added, though they continue to remain net short with 76% of their positions on the short side. Moving to the options data then, 2 strikes were very active. 23,500 call. This is getting written for the last few trading sessions. Even yesterday, more than 30 lakh shares getting added there. And on the downside, this 23,200 mark is very, very important. And we are seeing signs of some put writing out there. So we'll keep an eye out on that front. But I'll tell you what, for the trend to turn, you'll want to see higher highs and higher lows as well, which hasn't been happening in the last few sessions. So the day's highs, in fact, if you just look at it, it's been on a declining trend. Every day we're making lower highs. Even if you look at the lows, on a day-to-day basis, you're making lower lows as well. So today you'll want to see actually the Nifty get past that 23,600 odd mark, which was yesterday's high. So that's going to be the important mark that we're looking at. So in terms of levels that we're looking at, you have the 200 DMA. That's the first reference point. Resistance at around 23,650. If you can get past this mark, then you're calling for another couple of 100 points on the upside. So this is the crucial resistance zone. While on the downside, going by the options data as well, you're looking at this 23,200 odd mark. The Nifty Bank, last 2 sessions, it's been showing that it wants to put in a bit of a fight. And the bulls, they'll be counting on the Nifty Bank. Even in yesterday's trading session, it managed to defend the lower level, which is the 200 DMA. and it's closer to the 200 DMA in comparison to the 20 DMA. But you want to see the Nifty bank do well from here on. And the sense is that if we have to bounce, well, this one needs to bounce and needs to see some kind of support coming in from the tech index as well. The Nifty Financial Services Index, one of the last few weekly expiries. So that'll be another index to track because today is Tuesday. So, you'll have one of the final weekly expiries. After this, it gets back to the monthly settlement.
All right, Nigel, thanks a lot for that setup. We'll keep an eye on the Nifty Financial Services, the last expiry today. But on that note, let's get you some equity calls today. Lawrence Belanco of CLSA says that in the short term, the Nifty is correcting off the October highs and continues to unfold towards that 22,800 to 22,990 downside target. Below this target level, he adds that the next chart support comes in at 21,281 to 21,555 area. He says he would look for evidence from the price structure and momentum indicators for a re-entry point around either of these price levels. He says, should the indicators fail to provide evidence of a tradable low at either of these levels, the risks will remain to the downside.
Okay, well, we have Mahesh Nandurkar of Jefferies commenting as well. He says an unlikely consumer sector earnings decline, broad-based earnings downgrade were the most disappointing aspects of the September 2024 quarter results as Q2. This is due to weaker revenue growth and margins. He says 12% earnings growth for Jefferies coverage. This is excluding oil and gas and metals, was still respectable though. Nifty EPS growth for FY25 is now projected by them at below 10%. Mahesh adds potential government spending pickup, easy liquidity should help growth sequentially. He goes on to add banking sector remains their high conviction bet and a buy. Okay, well, Jeffrey Dennis is with us, independent emerging markets commentator. Jeffrey, good to have you with us here. Thank you very much for your time. Prashant this side. So a little better overnight, but it's not really helped. US markets going up or going down hasn't really mattered since that top in September for India, where there has been continuous FII selling. The intensity is coming off though. And many are starting to say, and we spoke to a bunch yesterday, who were saying that maybe it's time to, get back into the market here. Your thoughts, Jeffrey?
I think it probably is in the short term a good time to think about getting back into the market. I mean, the way I'm looking at the overall situation here is that obviously you've seen a tremendous rally in the US and a poor performance by emerging markets since the presidential election on November the 5th. And that's because investors are pricing in now higher bond yields, a stronger dollar, etc., possibly a slower rate of decline of Fed interest rates. So what that does is it tends to suck money out of the emerging markets. And my LinkedIn posts recently have really changed their tune. And I'm much, much more cautious about EM now in this environment because the Trump trade, so to speak, assuming it goes further, we'll have to see, isn't just not favorable when you get those sorts of conditions. Now, India is always going to be vulnerable when you get this sort of situation because it's so highly priced and it so was obviously a few weeks ago so highly regarded by investors. But now that you've seen it coming off considerably, and I do really still believe in the growth story in India, I think if you get a stabilization for a period of time in some of these key overseas variables, such as bonds and such as the dollar, I think you will see India beginning to make some sort of a modest recovery. But don't let me muddy the waters here. This is a much, much more challenging environment, I think, for EM following President Trump's election, I guess, about 2 weeks ago now.
So what would your allocation then be, or how would that shift in DMs versus EMs? And if you could, talk about your pecking order in emerging markets itself.
I do think obviously we have to see how this whole Trump thing plays out. And the key issues, as your viewers will know and are how much does he increase tariffs? And how much do other countries retaliate? What is the impact on all of this going to be, including tax cuts on the US fiscal deficit? So for me, the key is to watch the bond market in the US, because what the bond market is going to signal is concern about the deficit and therefore the debt levels. And I think bond yields are probably going quite a bit higher over the next, let's say, 12 to 18 months. Maybe, maybe no more than 5%, but enough, I think, to pose some sort of challenge to the emerging markets, indeed to equities maybe generally. At this point, I would tend to prefer at the margin the developed markets to the emerging markets, but I still think it's worth pointing out that within EM, you've seen some very good gains year to date, although India's pulled back recently in India, more recently in China, also in Taiwan, also in places like South Africa. So where I am is to tentatively take a look back at take a look again at India in the short term for an overdue. I think still be long Taiwan because I think tech continues to look good selectively in other emerging markets such as in the ASEAN region. And it may be time to start taking a look at some of the oversold Latin American markets as well. But mark my words, I think this is a much, much more complicated environment now for EM because of Trump's election.
Hi, Jeffrey. Good morning. The last time we chatted, we were trying to factor in Trump coming into power, and that's precisely the way it played out. And you had mentioned in the past, India over China and Brazil over Mexico. That's your preference. But, you hinted that maybe the yields could head towards 5%. Well, I'll tell you what, a lot of our viewers will be hoping not, because that will not be very, very good news for emerging markets. What are you pricing in with regard to the Fed? Another rate cut coming in the next meeting, point number one. Point number two, what about the dollar index? That moved to around 107 and it moved very, very quickly.
Yeah, forgive me, sorry. I do think, of course, the other things that will influence the Fed are the inflation numbers appear to have stalled out at about the 2.5% level for the headline, just over 3% for core. I think they'll come down a bit more, but it's going to be slow going from here. The US economy looks pretty good. Now, I think what that probably means is the Fed cuts in December. And as of this moment, I think the prospect of 4 rate cuts next year, which is what the dot plot says, 4 rate cuts in the US is very, very unlikely. And I think it's more likely to be something like 2. And if it's not 2, it could be less than that. So I think, and again, inflation obviously is going to be impacted by these tariff increases. So you've got to see how that all plays out. So as far as I'm concerned, as I say, this is a challenging environment, and I think what it does mean, and you've just said it there yourself, is that the dollar is going to continue to be well bid, and that's completely against my long-term view just a few weeks ago that the dollar would weaken. And if the dollar continues to be well bid, European economies are weak, I think we possibly challenge parity against the euro. That is not good for emerging markets overall, and I think this is, as I say, it's a more challenging environment than I thought was the case several weeks ago.
All right, Jeffrey, we'll leave it there. Thank you very much. And I think you made that point clear. Absolutely. Appreciate you joining us here on CNBC-TV18, as always. Let's just quickly tell you what's lined up here as we get into the show. So we've got lots of interactions lined up. You'll hear from Venkatesh Balasubramaniam, he's a veteran analyst, of course, now with JM Financial Institutional Equities, from the sidelines of their conference. We'll talk markets with him. 9 o'clock, we have the management of Medplus Health Services joining in. We've got some investors who've sort of sold stake in the company. We'll ask Mr. Reddy about that and more. 9:20, Andrew Holland will be a market master. 9:30, you'll hear from the management of IRB Infrastructure. The company plans to transfer 5 matured highway assets towards InvIT. Tarun Garg of Hyundai Motor India will be speaking with us at 9:40, second quarter earnings in focus. And of course, at 10:15, you'll hear from Lata in conversation with Pranjal Bhandari of HSBC and Abhishek Upadhyay of ICICI Securities as they talk about second quarter earnings wrap up and, of course, the economy. That's the lineup here.
Time to slip into a snappy break, but we've got a lot of stocks that we're tracking for you. We're looking at GMR Airports, PG Electroplus, ITI, Gulf Oil Lubricants, Z Entertainment, Shilpa Medicare, AstraZeneca Pharma, as well as Colgate. All of them will be reacting to positive news flow, while we have Vari Energies as well as Medplus that will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail on all of these names.
Watching us here on Bazaar Morning Call, the Gift Nifty indicating a near 70-point uptick at start. Let's see where we go from here on. But a lot of individual stocks in focus post-result season. So a lot of news-based stocks as well. So we do have our CNBC-TV18's list of top stocks for the day. Our team joining us this morning. Good morning, guys. Let's bring in Upasna for a bunch of stocks that are in news this morning. Upasna.
Good morning, Mangalam. So first up, let me start with GMR Airports. The company has reported its October air traffic passenger data. Now, October passenger traffic saw a growth of about 9% on a YoY basis and 5% month-on-month at 1.07 crores. Now, company said that it has consistently maintained the traffic levels above 1 crore passenger per month since December 2023. Now, aircraft movements was up 9% on a YoY basis and 7% on a month-on-month basis. Next up is PG Electroplast. The company signed a definitive agreement with Spiro Mobility to become an exclusive manufacturing partner for manufacturing of EVs of Spiro Mobility in India. Hence, even this stock will remain in focus. Next up is ITI. The company has backed contracts worth 95 crores for mining digital transformation and surveillance system in Uttarakhand. Mind you that the company has recently entered a consortium partner and emerged as a lowest bidder for BharatNet Phase 3 project worth almost 4,559 crores. Next up is Gulf Oil Lubricants. Even this stock will be in focus as ICRA has upgraded the rating to AA+ from AA for company's long-term fund-based cash credit limits of the company. Hence, all these stocks will remain in focus today on our radar.
Okay, all right. Thanks a lot for that, Upasna. Well, let's hop across to Vamakshi. She's tracking a couple of names. Z Entertainment and Vari Energies. Morning, Vamakshi.
Well, good morning, Nigel. Let me first start off with Z Entertainment. The stock is expected to open higher today, and that is because Puneet Goenka has stepped down from his position of MD. And in fact, this has been done in order to concentrate on his operational responsibilities as the CEO of the company. With this step, he intends to dedicate his entire time to focus on improving the operational performance as well as the profitability levels for the company. As far as his terms of appointment is considered, his salary will include a variable portion of nearly 40%, which will be tied down to achievement of certain targets. And keep in mind that these targets were revised earlier on November 17th and were in fact enhanced. In addition to that, they've also appointed Mukund Galgali as the deputy CEO. He will be assuming his role in addition to his profile as the CFO. So overall, they're strengthening the management team, and that is the reason why I'm going with the green for this company. But apart from that, keep an eye out on Vari Energies as well. The company reported Q2 numbers. They were a rather muted set. Revenue saw an uptick of only 1%, so it was rather flat. The EBITDA margin too was flat, in an improvement of only 6 basis points out here to 14.68%. And the net profit, however, was up nearly 15%. But keep in mind that this growth is largely being led by multifold growth that we saw in the other income. The order book for the company stood at 20 gigawatt. The board additionally has approved investment up to 600 crores for setting up and development of infrastructure for the purpose of developing renewable power projects and the bidding pipeline. But overall, it's a muted set. So therefore, going with the green because the stock had seen a good run up yesterday. Going with the red, sorry.
All right, Vamakshi, thank you very much for that. More stocks with news flow. Back to Vinny. Vinny, morning.
Good morning. So we'll start with some of the pharma names. Your Shilpa Medicare, we're expecting a bit of a green today after that Shilpa Pharma Life Sciences has gotten a certificate of suitability from the European Drug Authority. And this is for the API drug, which they have is octreotide. So keep an eye on that one. This drug is used for treatment of high levels of growth hormones caused by acromegaly. So keeping an eye out on that, green expected here. AstraZeneca Pharma, also we're expecting a positive up move here. They've received an import and market permission from the DCGI for its inhalation preparation drug, and this is going to be launched in Jan 2025. So yes, an important up move coming in for AstraZeneca. Medplus, yesterday we did see that big block deal that happened. Now we do have the names that are coming in. PI Opportunities has sold 5.77% stake in the company, and we have SBI Mutual Fund that has offloaded around 0.84% stake in the company yesterday. So overall, we could see a bit of a red coming in on the screen because PI Opportunities has completely exited the firm. Now, there are some buyers that have come in. Interesting name, Morgan Stanley, Franklin Templeton. We have Invesco Mutual Fund as well as Kotak Mahindra Mutual Fund among some of the buyers. Lastly, Colgate also in focus. They have actually started an initiative which is for AI-powered personalized dental screening for oral health movement. So keep an eye out on that one.
All right, we'll keep an eye out on all those stocks. Colgate, of course, will be in focus as the company looks to grow its category, increase the penetration out there as well. Thanks a lot for all those stocks which are in the news, Vamakshi, Vinny, as well as Upasana. Let's give you a quick recap of all the stocks. We have stocks like GMR Airports, PG Electroplast, ITI, Gulf Oil Lubricants, Z Entertainment, Shilpa Medicare, AstraZeneca Pharma and Colgate with positive news flow, whereas stocks with negative news flow are Medplus and Vari Energies. All right, let's bring in Manisha Gupta for a roundup of all the action from the commodity space overnight. Good morning, Manisha.
Morning, and thank you for that. Well, the New York session on Monday has been quite strong, and we've seen Tuesday morning in Asia actually follow through it on that. So if I start with the crude oil prices, we've seen 3% of gains come in for the overnight markets. There is an Norway oil field power outage where the production has been halted, so that supply concern has been supportive. And then, of course, the Biden administration allowing Ukraine to use U.S.-made weapons in Russia has added to more war premium coming in for the prices. The markets also are looking at China PLR movement decision that comes in this week, and that would give you further sense in prices there. But it's not just crude, because when you look at metals, we've seen strong gains here as well. The gold prices rebounded by 2% overnight. Silver gained up by 3%. The dollar index, which gained 1.6% in the previous week, has seen a pause in that rally. That has been supportive. And that goes for metals as well, where copper, aluminum, zinc, even steel prices gained up by 3%. So almost everything in commodities trading in positive in Asia.
Okay, all right, Manisha, thanks a lot for that. Well, time to slip in a short break. Up next, we'll get chatting with Mr. Venkatesh of JM Financial Institutional to discuss the recent FI outflows as well as the past quarter's numbers. Stay with us. Well, the big news maker from last evening, Finance Minister Nirmala Sitharaman played down concerns over a potential slowdown in the economic growth. Speaking at the annual SBI conclave in Mumbai, she said there is no reason for undue concern and India remains in a strong position. The Finance Minister also believes we need more conversation to discuss the inflation and interest rate dynamics. Let's hear her out.
Let me assure you that the government is fully aware of the challenges posed by both domestic and global factors. There is no cause for undue concern. India's economy remains resilient, underpinned by strong macroeconomic fundamentals. FDI inflows have demonstrated healthy growth in FY25, reinforcing global confidence in India's economic potential. Our foreign exchange reserves comfortably cover 11.8 months of imports and exceed 100% of external debt, underlining the strong net buffer in the Indian economy. The government is closely monitoring an evolving situation. We remain committed to taking all necessary measures to ensure that India remains fully and firmly on course to become the third largest economy in the world.
How concerned are you about inflation? And what is the view as far as interest rates are concerned? Do you expect a cut anytime soon, or do you believe on account of where inflation is at this point in time, the cut perhaps is going to be further pushed out?
You know, this is a question which I'm sure every journalist would love to ask. And Shireen leads the bandwagon. I respect her for asking me this question. I will certainly try to give an answer. Global markets don't go by your demand and supply ups and downs. They want a consistent flow of pulses to come into India. So complex issues, but very much affecting the common man. So inflation gets actually very, very volatile because of the supply-demand constraints. Equally, I think what is important is when you look at India's growth requirements, and you can have so many different voices coming out and saying the cost of borrowing is really very stressful. and a time when we want industries to ramp up and move building capacities, bank interest rates will have to be far more affordable. So I'm putting as much what Shireen asked me as a reply back to you, saying these are our requirements if we have to make Vikasit Bharat not just an aspiration but as a reality. So we need to have a lot more conversation on this, and I would stop at that.
Well, that's the Finance Minister answering questions from CNBC-TV18's Managing Editor, Shireen Ban. We have Venkatesh Balasubramaniam now joining us, Managing Director and Co-Head of Research at JM Financial Institute Equities. Venki joins us from the sidelines of the JM Conference, India Conference, which is kicking off. Venki, good morning. Great to have you with us here. Thank you for your time. You know, those who, for the uninitiated, Venkatesh, of course, was the veteran capital goods analyst for a very long time at a top sort of institutional broker. And of course, he's taken on his roles and responsibilities at JM Financial fairly recently. Venki, welcome again. Just a quick word on your sort of understanding of you know, where the market is headed from here, and what are the 2 or 3 sort of things which are at the heart of answering that question, the dominating drivers in that sense. Venki, go on.
Okay. Now, look at it this way. I mean, I think a lot of things started unraveling somewhere around, somewhere towards the end of September, when the Chinese government started giving a stimulus package. Now, when the Chinese stimulus package came through, most foreign institutional investors realized the Chinese markets are trading at a 1-year forward PE of 8 or 9 times. Meanwhile, India, through July to September, was trading at almost a 1-year forward PE of 21 to 22 times. Now, that is almost above 1 standard deviations from the mean. So the call was, is there a case to move some amount of money to China? So we believe that in the month of September, at least towards the end, there has been a move of money. China saw FII inflows of almost $96 billion. Now, once that passed, we moved into October, the month of October, and earnings season, I think, started somewhere around October 5th or 6th. Now, what happened in the earnings season was results were mostly disappointing. When we did our analysis, we realized that almost 66% of the companies in our coverage have seen EPS cuts during the earnings season. Almost 45% of the companies have seen target price cuts. We have also observed that a very clear trend that small and mid-cap companies, we are seeing higher amount of EPS cuts than in large caps. And also we observed that in small and mid-caps, a greater than 10% EPS cut was quite common, which was not very common in the large caps. Now, that was most of October. In the month of October, we almost saw, $13.5 billion of FII outflows. Thankfully for you, DII inflows of almost 12.9 billion kind of counterbalanced the whole sell-off. And that is why in the month of October, you saw the broader Nifty correcting by only 6%, despite the fact that this was the largest single month outflow of FII money from India. Now, as we moved into November again, unfortunately, with Trump coming to power, it basically indicated to the market that the US dollar would be stronger. It also indicated that interest rates could be higher for longer. Now, we also believe that at that point in time, there is a possibility that FIIs might have taken a call. The US market looks very interesting. How about taking some money back? So what we have observed is the FII outflows have continued in the month of November so far. So this is where we are poised, and this is when we are trying to host our India conference. Now, the thought process is very simple, that valuations have corrected. Sell-side analyst estimates have also got cut. So valuations are slightly more reasonable. I wouldn't say India valuations are cheap. We are still trading at almost 20 times P 1 year forward, which is not cheap because the mean is somewhere close to 17 or 18 times. But this is a good time for investors to start once again analyzing their, whatever they have cherry picked so far and start analyzing them. And that is what we are facilitating in our conference, that people can come and meet some of these corporates in the conference. At some point in time over the next month or so, we believe FII outflows will start coming down meaningfully. At least outflows will stop. I'm not sure when the inflows will start, but outflows will stop. So this is a good time to once again start looking at things. We also believe on the Indian economy side, corporate capex will start picking up in the second half. We also believe that rural demand has started picking up. So some of these positive factors are still there, and domestic SIP inflows will continue. So it is a very good time to start looking at companies, figuring out where are the pockets of ideas that you should be buying.
Okay, all right. Hi, Venkatesh. Good morning and good to see you in. This is Nigel on this side. Very, very valid points you're making on that
morning,
front
Nigel.
For investors to come and post this correction. Risk, I mean, it's far more favorable when you're buying 10% low on the index itself and stocks have corrected more. Talking about the domestic flows, we were talking about the mutual fund industry sitting on cash of roughly around 1.6, 1.5 lakh crore odd. Now, what's happened in the month of October, as you mentioned, the FIs were selling lock, stock and barrel. The domestic money was buying that. So we have seen a fair bit of deployment out there. In addition to that, we have IPOs where money was deployed as well. But we have the SIPs that continue to look quite strong. You have a ballpark number. What kind of liquidity is the mutual fund industry sitting on? Because we're banking on them. We are hoping the FIs stop selling and we're banking on the domestic liquidity. So if you'll have a rough number.
See, look at it this way. Even if you assume whatever was the cash levels at the starting of October have got deployed over the month of October, on a monthly basis, you are at least having ₹500 billion of mutual fund inflows which are still coming in. Even in the month of October, what have we observed? We have observed almost 590 billion rupees of inflows into domestic mutual funds. Out of that, of course, roughly 70 odd billion is basically arbitrage flows. Even if you take them out, that's roughly 518 billion rupees of inflows. We believe these inflows can continue for the near future, especially given that 50% of that is basically SIP inflows at almost 253 billion. So we believe that there is enough and more money in India to support this sell-off. And at the end of the day, the sell-off has come down a little bit. At least it has started decelerating. At some point in time, it will also end. Maybe it will take a month more, but the deceleration will happen. And as people observe that third quarter is perhaps not as bad as the second quarter, obviously FII outflows will kind of stop.
Okay, all right. Just to summarize that, Venkatesh, hopefully the FII outflows slow down, and you believe that domestic money is adequate. I think it's around 5% of the total industry size, and that's adequate to support the market, right?
Yes, precisely.
Got it. What would be the realistic assumption on earnings, though? I'm looking at the BSE 500 companies. The earnings growth for the first half was little south of 10%, I think around 9%. And for the year, still consensus is working with, I think, 16 to 17%. The government spending is there, yes, but the base as well is a little bit higher. Realistically, what should the earnings growth look like?
We usually look at earnings growth on the Nifty. And now, given that the quarter is largely over and most of consensus and our own analysts have cut numbers, our analysts predict that the Nifty growth for the current year is more like 6 or 7% odd. That is what we are expecting for the current year. So this year, on a relative basis, we have seen a deceleration. We are expecting a rebound the following year, which is FY26, where we are expecting almost 17 to 18% Nifty EPS growth.
All right. Interestingly, the domestic mutual funds, or MF holdings, if you look at it, they're overweight on pharmaceuticals, healthcare, capital goods, and consumer durables. Sectors which saw the highest FII outflows included the likes of BFSI, oil and gas, and FMCG. Whereas the sectors which saw a fair amount of inflows, or the only two sectors which saw inflows, were chemicals and metals. Would your sectoral position or call be similar to what the mutual fund industry is overweight on and what the FIIs are buying in terms of sectors right now as well? Or would you have a different outlook here?
Okay, see, on the long side, the sectors that we like are obviously one of the best sectors we like currently is metals and mining. And I'll kind of lay out the reasons for you. At this point in time, spreads are high. Why are the spreads high? Because input costs are lower, especially coal prices are on the lower side. Now, with the China stimulus, we are expecting metal prices to go up more. Further, when Trump takes over presidency, normally he puts a lot of import tariffs. Now, that also leads to higher prices on the metal side. So, we believe that the next couple of years could be a very good time to own metals, and we would advise most investors to be overweight on metals. Now, what beyond metals? Now, if you look beyond metals, some of the sectors that we like at this point in time are basically IT, pharma, diagnostics. This is something which we really like. We also like the asset management industry. So, ownership there could be good. Amongst the banking and financial space, we are a little partial towards PSU banks. Given that we are expecting interest rates will be higher over the next year and a half, once Trump comes through, we believe that NBFCs will not do that well given their fixed rate asset books. And between private sector banks and PSU banks, we have a slight preference for PSU banks because valuations look more reasonable. So these are some of the sectors where one can be overweight. Chemicals is one sector which you mentioned where there was FII inflows. Good time to start looking at this sector, but we would wait for another 6 to 9 months before we would advise people to start building positions. The reason there is maybe you will see another quarter or so of earnings cuts, so valuations become more reasonable there. But yes, Trump coming to power is very good for export-oriented sectors because we believe that Trump will definitely put higher tariffs on China vis-a-vis India. And what that does is if you have sectors like, say, chemicals or maybe even wires and cables or tiles or a few of the other sectors which are export, they would definitely benefit in this kind of a scenario. And obviously, what you are noticing now is FIIs are already positioning themselves for that. So that is why you have seen inflows in chemicals.
Very interesting calls out there, especially on the metals front. And the PSU banks, unlike a lot of the other conversation that we've been having with a lot of experts who do believe in private sector financials, but Prashant, interesting ones out there.
No, absolutely. And Venkatesh, thanks very much and hope this is the first of many conversations here on CNBC. Appreciate it. Well, that is the conversation from the sidelines of the JM Institutional Conference. We'll take a quick commercial break here. We'll have Mitesh and Sudarshan joining us on the other side. We talk specific trades. Stay with us.
Welcome back. You're watching us here on Bazaar Morning Call. A bunch of stocks on our radar, a bunch of conversations overnight. Can today be an IT day or not? Will today actually be the day where we see a bit of relief for the bulls after 8 days of relentless selling? Well, to answer a lot of your questions, some of them stock-specific as well, we have Amnish Agarwal, who's the head of research at Prabhudas Leeladhar, joining in. Amnish, thank you so much for joining in. Good morning. Two stocks I wanted your thoughts on at the outset itself. First one, of course, is Mamaearth, Honasa, which was down about 20% in yesterday's trading session. Weak numbers coming in. And the second one would obviously be Swiggy, because the Swiggy versus Zomato market cap valuation differential sort of battle is playing out as now both of them are listed. So on both those counters, if you have a view.
Okay, hi Mangalam. You see, as far as Honasa is concerned, I think this is typically what happens in many of the consumer companies. Honasa started with their lead brand focusing on the, you can say, B2C on online platforms. And later on, they went into your all the general trade. Now, if you look at commentary of not Honasa, but many of the other companies, what has happened is that the fast growth of quick commerce has actually clogged the general trade to quite a good extent. And that is why many companies, some might have taken, say, 6 months earlier, a couple of them have taken now. So they are taking some sort of a, you can say, inventory destocking. And Honasa also suffered due to that. The second is that, you see, it is a fairly young company. Today, when it comes to the entire, your particularly personal care, hair care, beauty products kind of a ecosystem, there the competitive intensity today is very high because you are getting all the global brands courtesy all these platform companies. So I think the going is never going to be easy for, you can say, many of these companies. And given the fact that particularly the young ones where the profitability is not so visible, they don't have a long track record of profitability, I think some reactions of these kinds are likely when the destocking happens at so early a stage. But having said that, I think it's going to take some time for the things to stabilize at Honasa. Okay, so I can't give you exact view that whether one should go or buy now or one should wait, because any which ways there is some sort of a slowdown in demand which is also there. But definitely, I think the times are going to be challenging for the entire space, although one might say that in the coming quarters, the performance of Honasa and many of these companies might show some improvement. Now, your second question was regarding Swiggy. So, you see, once you start analyzing Swiggy, then the typical debate boils down to Swiggy versus Zomato. And when you look at the various parameters in terms of throughput, in terms of margins, and some of these, you can say today's Zomato is far better placed than Swiggy. There is absolutely no doubt. The second difference is that if you look at the past 3 years kind of a period, then Swiggy has actually in the last 3 or 4 years lost market leadership in the key segments. For example, they were the first ones to start quick commerce. Today they are, say, number 3. Even in case of food delivery, Zomato has raised ahead of them. So, and in the, you can say, typical marketing scenario, what usually happens is that the leader makes maximum amount of money. So to that extent, I think what is attracting investors to Swiggy is that the market cap of Zomato is, I think, roughly around, say, anywhere 2 to 2.25 times than that of Swiggy. So that is something which is making, you can say, Swiggy attractive to investors. But having said that, if someone wants more clarity in terms of profitability, more, you can say, success in terms of, say, hardcore numbers, then I think Zomato seems to be far ahead than Swiggy at this point of time.
All right, so Zomato's far ahead of Swiggy, even as there is a fair amount of valuation difference between the two. Before we move further, just a quick thought on all these city gas distribution companies, because for twice in a row, GAIL has gone ahead and cut the APM gas allocation to them. The street believes that this is the start of, derating for these stocks, as a result of which, we saw big cuts in IGL, down almost 19% in yesterday's trading session. MGL was no different. After these cuts, do you think that, it makes a case for maybe buy, given the larger opportunity of natural gas or piped gas being delivered to most places?
Okay, see, there are two ways to look at it. One being that your allocation from GAIL has been cut. And if you look at over the years, the allocations have not been going up for city gas distribution companies because the gas is also being diverted for some of the other priority areas. Now, from the second angle, when it comes to now move towards the greener fuels, whether it is EV, whether these are hybrids or whether it is CNG, definitely there is a lot of scope. And many of these companies, they actually depend a lot on what happens on the, you can say, automotive front, what happens on the, you can say, domestic PNG also, although I think they make maximum amount of money when they supply to automotives. Now, I think in the longer term, the demand is there, and I believe that even if the supply to them is cut by GAIL, then they will be able to, I think, they will import us and compensate for that. And I think if you look at the past 5-10 years, kind of a longer view, do they have pricing power? The answer is yes. So I think it's a kind of very sharp reaction which has come in. Okay, but having said that, at a lower level, yes, they could be good trading bets.
All right. Amnish, we'll come back to you in just a bit. We have Mitesh also joining us, Mitesh Thakkar and Sudarshan Sukhani, with what they're making of things. Gentlemen, good morning. Good to have both of you here as always. Mitesh, let's start with you. I think GIFT Nifty is indicating a slightly higher start, though the close is going to be more important in how we trade through the course of the day. What trades come to your mind? Index and then stocks?
Morning, Prashant. You put it correctly. I think, the opening is good, but what will matter possibly is the closing. And, I've been calling for some kind of a market pullback, given the fact that we have a scenario wherein the indices are showing extremely oversold readings, and they could therefore give some kind of a bounce. So I'm slightly positive for the time being. And my understanding is that today could be the day when we could see at least, if not a big reversal, at least a strong pullback rally. And then let's take it from there. So the level which I watch on the upside is obviously getting past the 200-day average first, which is around 23,550, 560 zones. I think we should at least test that. If we start sustaining above that, then I think we'll look at possibly this rally extending to about 23,800, 850 zones.
All right, Sudarshan, your call on the index and topics?
Yeah, good morning. Well, the markets are now coming to a standstill. We have been talking about how momentum is falling, although the decline continues. Yesterday, again, we saw a de-acceleration in the momentum of decline. That is the first sign that perhaps some kind of a stop is coming to this fall. Now, it may or may not last, but today is probably a good day to find out. So for short-term intraday traders or swing traders, there's a buying opportunity. Now, that buying opportunity doesn't come at the open. There's no need to chase gaps, but any small intraday decline in early hours should be used to take a long position in the Nifty and the Bank Nifty both. And when we see where we go, keep the stop at 23,400. And it's a matter of chance, but it's worth taking the long side.
Okay, all right. What about individual stock ideas? Sudarshan, you go first.
All right. Well, I have mainly buy ideas today. Havens is a buy with a stop under 1,600. Now, the stock hasn't actually recovered from the decline. It's just moving sideways. So maybe the sideways is a substitute for further declines. We'll see. Similarly, Indigo is a buying opportunity with a stop under 3,900. Same pattern, big decline, sideways movement when the Nifty was again declining. So let's see whether this sideways is preparatory to an up move. And the third is Syngene, which is an intraday short with a stop above 860, and that is because of the big hammering IT took yesterday. Muthoot Finance is the last buying opportunity, it's the last name in the list. It had a big gap up yesterday. It may tell us that perhaps.
Okay, I think we lost the line there with Sudarshan. We'll just try and have him back. Mitesh, you want to step in? Your stock calls?
Yeah. So for me, I think, I would look at a couple of buy calls today, hoping for a reversal. So Hero Motors is a buy with a stop at 46.75 and 47.80-90 is my target area. Jubilant Foods, after excellent numbers, has been slightly subdued, but just been giving a pullback to the averages. So buy here with a stop at 5.97. Look for targets of 6.30, and also buy on Chola Finance with a stop at 12.27. We'll take a tight stop and looking for a pullback to about levels of 12.80. On the selling side is HDFC AMC, around 42, 30, 40 zones. So sell on a bounce back. Sell with a stop at 4,300 and look for a target of around 41.20.
All right, gentlemen, thanks a lot for that. We'll take a short break, come back with the pre-opening rate. We'll be joined by the management of Medplus Health as Premji Invest and SBI Mutual Fund have divested about 6.5% stake in the company. We discuss the plans for the company after this short break. Back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio, 14 minutes away from market opening. The pre-open rates have come in, as the GIFT Nifty was indicating, almost 60 points higher on the Nifty, though we have to allow them to settle and at the same time wait for the market close as well. But when we're talking about markets, today the primary issue is in focus, that of NTPC Green. 10,000 crore rupee IPO opens for subscription today, closes on November 22nd. The management, remember, earlier told CNBC-TV18 the proceeds of the IPO will be used for capex and they're likely to commission 90 gigawatts by 2027. Let's hear out what the management had to say to us.
We have already chalked out programs to go up to 60 gigawatt by 2032. And this is what we had declared almost about 2.5 years back. Today, when the storage prices are coming down, we believe that we will be able to achieve that before 2032 rather than waiting up to 2032.
The proceeds of this 10,000 would be essentially for fueling our capital expenditure. It's almost 19 gigawatt in the next 3.5 years. But however, intermittently we may use the proceeds also to, retire some of the costly loans temporarily. But broadly speaking, it is meant for a capital expenditure. The present debt equity is 1.91. But however, we will be implementing all this with a debt equity ratio of 80-20.
As you know that NTPC supplies almost 1/4 of the electricity to the entire country. We have the pan-India presence. So similarly, NTPC Green Energy will be playing the similar role, that it will be leading green energy company which will be having footprint almost everywhere. But to start with, what we are doing is that the areas where there is a maximum potential for the solar and wind, we are focusing on that, which is like Gujarat, Rajasthan, Andhra Pradesh, Telangana. These are the states where we started, but going forward we will be going almost across the country wherever there is a potential, whether it's for solar or wind, to meet the peak requirement and to have the grid stability during the day when there is excess solar. So it's both, there is a combination of that. So there will be huge capex requirement for the storage solutions. We are working on that also. And going forward, there will be another important segment, which is the fourth segment, which is called the green molecule. Going forward, there will be storage solution as well as the green molecule solution, which will be FY27. We will be having 19 gigawatt commissioned, but that does not mean only 19 gigawatt. There is a work which is going on continuously. And what we intend is that what we had said about the 60 gigawatt by 2032, we should be in a position to commission that before that.
Amnish, what do you make of this issue? NTPC Green, plenty of interest out there. They're priced it quite favorably as well. Your view?
Yeah, so Nigel, NTPC Green is into, you can say, as the management said, green energy, solar, wind. You see, the closest comparable for that seems to be Adani Green. So if you compare the valuations of, say, Adani Green and this company, then definitely the plans are very ambitious. The growth rates will be high over the years. Is the stock cheap? I would say no. But for the investors who are ready to bet, say, for the next few years, I think the growth will come, and in the long term, one will make money. But definitely at the current price of, say, 108 odd rupees, with a market cap of, I believe it should be roughly around, say, 85 to 90,000 crores. So on a relative basis, you might find it to be attractive. On an absolute basis, I don't think that the issue is going to. It is cheap in any which way.
All right, we take that point. Thanks a lot, Amnish, for joining in. You might want to, stay on to listen into this conversation that we're likely to have with the management of Medplus Health Services. The first management on the show today, Premji Invest in SBI Mutual Fund yesterday divested about 6.6% stake in the company for about 550 crore rupees. Remember, the company has reported a good set of second quarter performance. So to discuss this and more, we do have G. Madhukar Reddy, who's the MD and CEO at the company, joining in. Thanks a lot, Mr. Madhukar Reddy, for joining in. We'd like to ask of you, these institutions who are selling stake, who's on the other side, who's on the buying stake, and whether with the prospects of the company looking so strong, you yourself would want to, increase your stake in the company further as well as these institutions offload some of the stake that they have. But that depends on how the fundamentals of the company grow. So let's talk about the fundamentals of the company itself. Two things that really stood out. One was, the overall margin profile of the company improved, and that was in congruence with your own private labels improving. You had earlier in the past indicated that, private labels should be about 25% of your overall GMV over the next couple of years. What's the differential in margins between private label and the regular products that you sell? And where should margins settle at once you reach that 25% mark for private label?
Yeah. So as you all know, private label is what makes retail tick, and it is actually no different in retail pharmacy also. To us, we are already at the 24-25% GMV, but that includes both medicines and non-medicines combined. So if you only take medicines, which is what I was talking about earlier, by volume, we should probably be at around 16.5% or something like that. I expect we'll continue to grow at the rate of around 1% by volume, which is on the MRP basis every quarter. And that basically adds roughly around 15 basis points to our overall margin. So I expect that we'll continue to do this over a period of time, and it'll be a slow but gradual growth because I think we already have the early adopters in. A lot of people, we started our private label in Medplus only last year, and since then we have gone from almost 0 to 16.5% on volume basis. So while there is growth, it's going to be slightly slower, but it is going to be inevitable.
So just a back of the envelope calculation out here, 1% increase in private label medicine volume adds 15 basis points to margins. You are at around 17%. You intend to be at 25%. So that's about 8 percentage points. If you back calculate that, the net impact of margin should be a positive 1.2%. Should we look at it that way?
Absolutely. It'll happen though over several quarters. But that said, I must say that unlike normal retail, grocery and other retail, there is no real cap on the amount of private label you can actually do in medicines. If you look at the US markets, US FDA will tell you that 91% of all medicines sold in US are generics. And by generics, it is private label of some store or the other. So if you go to Walgreens or CVS or any of the other stores out there, they'll either give you the innovator product or they'll give you a generic. And that generic is the equivalent of what we are doing right now, the private label. So, the one differentiation I'd like to make is when you, let's say, go into a grocery store to pick up a store brand soap or something like that, there are some people who will pick it up because, it is inexpensive and they believe it is the same product anyway. But a lot of others will have some brand loyalty, and that is because, the brand itself may have some kind of a unique thing. It could be a fragrance, it could be a texture, it could be some other quality which you really like in that particular brand, so you're not willing to switch. But unlike that, medicines have no such difference. A 650 mg paracetamol is 650 mg paracetamol. If it is made in the right factory and to the actual standards, it should not be any different at all. Hence, you don't see any cap in the private label. It's just that people have to accept that it is the same quality, and it'll take a little while. So while I say the near-term target for us is 25, the long-term target could be anything.
Okay, all right. Hi, Mr. Reddy. Good morning and good to see you in. Just a quick question on the shareholding pattern. What is the feedback? Last few months, there's been a lot of action. One big shareholder getting out, another one coming in. Do you think for now, all those big shareholders are satisfied who are left and who wanted to leave, they're out? All the clean-out trades have been done?
I think so, but I wouldn't really see it as a clean out. I think it is one type of investor giving way to another type of investor.
True.
We started the company in 2006, and we have had several sets of private equity investors. And the last two private equity investors, which is Premji Invest and Warburg, they entered the business in 2017 and 2018 and 2019 and 2021. And their mandate was to basically take the company public and find an appropriate time to exit. So they have done their job. They helped the company through our growth process and everything else and all. And now I believe it's time for the public market investors to come in. And I think we have had the guys who actually replaced them are excellent partners to have. And I feel obviously very happy to have this guys next journey.
All right. Mr. Reddy, we have our ear to the ground, but always better to clear these things, because sometimes shareholders are wondering whether it's an opportune time, but if there's going to be another big shareholder who's going to come to sell, then they just delay their purchase of the stock for a bit. Let's talk about business though. Your store addition, I think for this year, you'd scaled down to around 450 odd. What's the current target for this year? And for FY26, you get back to that 600 odd mark. Also, with this shift in private labels, what does it mean for your working capital?
So, two things. We have already announced that we'll do between 400 and 450 net stores, so that's on. We lost a little bit of time in the first quarter because of elections and a couple of other things out there, and we are not really now eager to make up for that. So that will be felt this year. But next year, as you said, we'll most likely end up going back to the 600 stores. On the private label side, well, in the long run, because private labels actually cost a lot more to actually purchase, it'll be a positive thing for the working capital for us. The thing is, it is too early because right now we have got both the brands and the private label. So it is, in fact, have actually bloated our overall working capital out there. But as we go forward and as it becomes more clearer on what we need to stock and what can't be substituted in the brands, then when we know that, we'll probably stop stocking the rest, and private label will take the position of those. And given that private label costs a fraction, 20% of what the branded things cost, I expect the working capital requirements will come down significantly.
All right, quickly before we let you go, sir, running short on time, the smaller part of your business, the diagnostic business, you've said that you won't invest any more money into this. For the last 2 quarters, it's been a bit positive. What is the likely run rate which is sustainable here?
It is still at a very early stage, I would say. It is still growing. Right now we're doing around 27 crores a quarter, so that's around 108 crores per year kind of run rate. I expect we'll continue to grow here. We'll see, how much. Can't really commit that number, but I expect it's still in the early stages. And we still, as you know, it's a different model. It's a subscription-based model. On that count, we still don't have the number of subscriptions we wanted, so we're not going to go and basically expand immediately on that side.
All right, Mr. Reddy, great conversation as always. Thank you very much for joining us. It's a pleasure having you with us here. That's the management of Medplus. I think we've got 2 minutes to go as far as market open is concerned. We're going to just highlight Suzlon as a stock which should be in focus. It was up 5% yesterday. It's fallen off quite a bit from the highs. Morgan Stanley has come up with an upgrade. They're saying, well, the thesis is intact. Sudarshan is here with details. Sudarshan.
So Morgan Stanley has upgraded the stock to overweight from equalate, but has cut the target to rupees 71 from rupees 78 per share. It believes that after steep decline in the stock price from 52-week high that stock had hit in September, it's a good time to accumulate the stock. And the rationale of the upgrade is first, business moat and growth opportunity for wind OEMs remains strong, and it believes that company will be a beneficiary of India's energy transition, and it expects market share to improve to 35 to 40% by FY27 versus 25% FY24. And India's wind additions will drive 32 gigawatt of orders over FY25-30. Talking about estimates, it believes it continues to hold its assumptions of 7.15 gigawatt of sales volume over FY25-27, but it has lowered FY25 wind turbine generator EBITDA margin by 50 basis points, but has retained FY26 and FY27 margin assumptions. So on the basis of these rationales, it believes that it's good time to accumulate Suzlon Energy.
Sudarshan, thank you very much for that. So that Suzlon in focus, market starting about 75 points higher on the Nifty, 200 points on the sensex at this stage. We'll look at the indices, headline indices, and then we'll of course look at individual stocks, etc. As well. So first rates should start to come up shortly. Look at names like Vari, Premier Energy. These are all solar companies. We're all up a bit over 10% yesterday by close. Of course, Vari's got some news flow, as Vamakshi was highlighting this morning. So first rates anytime now, and it's about 1/3% higher to begin the day. So 90 points, so 23,500 plus, 77,570 or so on the sensex, and the Nifty Bank is starting about 1/4% up. 50,470, 80 roundabout is where we are starting. Mid-cap index is up about 0.5% as well. Look at that. The Nifty heat map coming into view. It's largely all in the green to begin the day. Just a few names are lower. So that's a good-looking screen. Now, of course, to the real task of holding on to what you started the day with. 23,555 is where we are starting.
Well, stocks in focus. I think the one top of mind is Honasa. Smacked back yet again, down another 15%. Yesterday it was down, circuit down 20%. It's lost another 15%. I'll tell you what, this is what will hurt investor sentiment as well. Because that's a stock that's way below its IPO price. It danced all the way to 500 rupees. Now it's half of what it was at its peak. So that one's clearly a worry. The other one is Vari Energies. The stock has opened up down close to around 5%. Now it's still down close to around 3%. And volumes are very, very large on that one. Akam Drugs, I don't know what's gone on there. But in terms of losers, that's coming up as one of the top volume losers, down close to around 4% or thereabouts. No respite for IGL, at least as of now. The stock is down close to around 1.5%. What's flying away in today's trading session? Well, the street likes the news with regard to Mr. Puneet Goenka. He's asked the Z board to relinquish him from his position as MD. For the timing, the street seems to have taken that very, very positively. The stock is flying away. ACME Solar, that's the new listing in there. That's up close to around 4.5% in today's trading session. So good up move is what we're seeing on that stock. Easy Trip was another stock that got smacked in the last few sessions. That's up close to around 2%. And Indus Stars, the stock has corrected from 450 all the way to 320. For the time being at least, that stock is seeing a good relief rally as of now. PG Electro Plus, that's the other one in there. Locked, upper circuit, 10% higher. There was some news flow with regard to their diversification as well. Now up more than 10%. So big up move is what we're seeing out there. Mangalam.
Well, on Honasa itself, it is a narrow exit door right now. Promoters own about 35% of the company. Remember, it's been a year since the company is listed, so everyone can obviously go sell, in the markets itself. Honasa is the one that I'm talking about. In the last two trading sessions itself, down almost 35, 36 odd %. Now, with today's decline, the stock is actually, in terms of valuation, fallen below that $1 billion mark as well, at about 8,100 crores for the market cap. 35% of the shareholding is with domestic and foreign institutional investors itself. So we'll keep an eye out on, the shareholding pattern out here, the delivery volumes, etc. On Honasa, down 16% right now. CMS Infosystems is another one which is down about 4 odd % as well. Kitex Garments, I mean, it's a lot of these motley crew of stocks which are doing extremely well this morning from the cash market. In the, other areas of the market, Trent, which was a big loser yesterday, has come back in today's trading session, straight off the bat, up around 2.5 odd %. The question is whether this up move sustains on that stock or not. Power financier companies are doing extremely well in today's trading session so far as well. So we have PFC, REC, which have opened with a fair amount of gain. NTPC, of course, on account of the opening of the NTPC Green IPO. A couple of these oil marketing companies doing well too, and a few of these upstream oil companies, the likes of ONGC, etc., doing better. IT stocks, relatively better than what they were yesterday, up 2% for Infosys.
Well, and as we did that market check, we're at 23,600. But as Prashant has been mentioning, the start is not as important as the end. So hopefully the bulls have something to cheer. Two factors that we highlighted earlier today. The dollar index is weaker. That's normally bodes well. And the FIs are selling, but they're selling relatively less.
Nigel, we'll only know, we'll only be wiser in hindsight. We'll have 2-3 days of flattish markets, slightly higher markets. Then we'll kind of look back and say, well, that was it. That was the point when the markets have turned. And it always happens like that. I mean, almost next to impossible to say that, well, this is it. And, that selling has stopped. And that we'll know from the institutional figures. But I think for the market to have turned, I think that we'll only kind of point to in hindsight and say that, well, that has happened. Market, of course, I mean, the good thing is, even if, for example, in the US there is some turbulence, etc., here we've already kind of, in that way, paid the price. We're off about 11-12% from the highs in September. So it's a tougher environment, as many have been pointing out, and that is all correct. But the prices are also down. They're not nearly as much down as they were in earlier bull markets. But when we talk about earlier bull markets, it's like a different era. We've had sharp corrections during bull markets, but that was back in pre-2010. The last 4 years have absolutely been just one way, with very little correction. And this 10% plus fall on the Nifty is the first that we've seen of this magnitude. So, in a different kind of a zone in terms of levels, in terms of pullbacks, etc. as well. Let's put some of these points to Andrew Holland, who's with us now. He's Chief Executive Officer at Avendus Alternate Strategies. Andrew, good to have you with us here. Thank you very much for your time. Andrew, of course, is someone also who's got a keen eye on some of the global stuff. And that, if one is to believe some, is the head, and emerging markets are now the tail. Would you see it like that, Andrew? We had somebody in the morning, Jeffrey Dennis, who was saying that it's a much more tougher environment because the competition for flows is not just other emerging markets, but it is the US itself. Just your thoughts there, Andrew.
Yeah, no, I mean, the US is really the only game in town, right, Prashant, because all the action's going to be there. And all the negatives, from what we know of what President-elect Trump is saying, is going to impact emerging markets. So I think, until he takes office and we see some of those policies, it's difficult to make a case. The best case we can make for India at the moment is that relatively compared to anywhere else, and that's mainly China, we're going to be okay. But that's really not a reason to buy. And if you think about, let's say calendar year next year, if you're expecting earnings growth of, say, 10%, which is looking like at the moment. So you could say maybe the index goes up in that kind of a level. But, in the US, I'm looking at, bond yields of 5%, because everyone's talking now of yields going higher or the Fed going on hold, if not increasing, the kind of interest rates in the second half of 2025. So 5% yield, given I might have depreciation in India of 5%, I might as well stick where I am. Why do I need to come to an emerging market? If anything, the one place to look at is China, because they do have a lot of power to dry, which they can use to stimulate their economy. For India, unfortunately, at the moment, the government spending's really not picked up, so that multiplier effect is not there going into the second half of the year, and there's no. Earnings are being downgraded, Prashant. We talked about this before. Volumes are lower than expected, but more importantly, margins are a lot lower. And so there's no, with the valuations still where they are, I just can't get excited at the moment.
But, although to be fair, Andrew, in the US also, S&P trailing P multiples are north of 25. So it's not as if valuations are cheap in the US, right? Here in India, as you asked, it was a rhetorical question. I understand. Why do I need to come to other markets, right? In the US, I mean, you got about 10, 12, 15 companies which are driving bulk of this gain. Everything else is down in the dumps. And maybe that'll pick up. Here in India, though, that's not the case. It's been the opposite, right? It's been small, mid caps, etc., which have led this rally over the last couple of years. Large cap returns have been okay. So there is that, Andrew.
Yeah. So going back to the US, but what do you have, Prashant? You have an expected corporate rate tax cut, which is going to be earnings per share, kind of accretive, right? And that's going to really help the kind of small and mid cap companies as well. And that's where the excitement is, and that's why there's a lot of talk about M&A picking up in the US. So it's going to be a broader based rally. Is what the market's telling us going forward in the US, and that's why it remains, kind of the main game in town at the moment. But for India, that earnings pressure is not going away for the time being, and I don't see what the upgrades are. So either the market consolidates and then earnings start to improve in the second half of 2025. Or valuations come a bit lower. So I think valuations probably come lower before earnings start to pick up. And plus, Prashant, one of the things that we've all been kind of banking on is an interest rate cycle, which is going to be lower. And now there's question marks about that, particularly in the US. And I think, unfortunately, the RBI will be on hold in December as well. So we're going to have to wait sometime into 25 before the possibility of a rate cut, starts to happen.
Hi, Andrew. Good morning. Good to see you. And Andrew, I take your concerns on board with regard to the Indian markets. And the Chinese stimulus was something that, started that entire shift of hot money from India towards China. But actually, their stimulus has been not as much as expected. And from an Indian government perspective as well, we're seeing spending actually has picked up just in the last month or so. So hopefully that holds us in good stead. So I get your point that it appears right now you lean more towards the US markets in comparison to an emerging market. But from the Indian markets, there'll be select stocks as well as sectors that still have a good runway. Something that you're bullish on here in the Indian markets?
Yeah, some of the themes that we've talked about before, which is electronic manufacturing sector, that's one theme which I think will continue to play out over multiple years. So I still like that sector, and of course it would be a beneficiary of potential tariffs on China as well. So I do see that as a theme that will continue to play hard. I still like the kind of hospitality sector in terms of people spending, so airlines, hotels. I still think, I was talking to someone the other day who said, they're trying to book a hotel for a wedding, and it's all booked through to March, April of next year. So, and these are in not just the main cities; these are outside of the main cities as well. So, hotels are continuing to see very, very strong demand, and obviously that's going to help their margins and revenues. So those are the two sectors which I like as a theme, which I think will continue, as well as premiumization, which we talked about before. So those themes are not going away from India, and I think that's where I'd like to play. The rest are going to be more trading ideas. I could make a case for buying metals at the moment on the back of that China will have to do a stimulus sometime in the next 2 to 3 months, and that will boost metal prices in the short term. So usually the market will play that out before, but these are more trading calls rather than long-term calls.
Are there any short trades that you have in this market right now, given the fact that there are weaknesses? Would there be anything that you would sell? You believe that despite the decline, there is further downside from here?
No, I think there is further downside. I think there's another, possibly, getting. If I had to have a nifty kind of trading range, then I'd probably say anywhere between 22 to 24 would be my kind of guess. And sometimes you overshoot that. But what I think will happen is that, you were talking about it prior to me coming on, is that FII selling anyway kind of goes down in December. I think everyone, wants to kind of, book whatever they've done and not take big calls unless there's something, more significant globally. And therefore, if domestic flows remain strong, you could see that kind of year-end rally. But I think it'd be a relief rally rather than it'd be a sustainable rally going into 2025.
Just a few names. Sorry, go on. Finish that point, Andrew.
So no, I was going to say that. So you're asking about short. So I think the market's looking a little bit oversold at the moment. So you might have that rally of 2%. So I don't think the short side is where it'd be. I think that for a retail investor, with all the things that are happening at the moment, just sitting on some cash for the next 2 months is probably not a bad strategy, and getting some returns from fixed deposits or liquid funds, just to see how President-elect Trump kind of comes in, what policies are, how that's going to affect all emerging markets.
Any thoughts on Swiggy, Andrew?
I can't talk about individual stocks, and as you know, we were one of the lead managers, so I really couldn't talk.
I see. Got it. By the way, I just want to highlight, it's looking good. 10:1 advances to decline ratio. So 10 up for every 1 stock down. And when's the last time we've had it? Usually we've had the reverse for the last many days, and 200 points now on the Nifty. So whatever happens after today, but I think as you go into the market holiday tomorrow, if you go home with this kind of a setup, I think portfolios will feel a little bit of relief, which have been, of course, under pressure all the way. The biggest volume-led gainer is Z, which is up 6.5%. The number 2 place is Paytm. Paytm, of course, never really had a big correction or anything of that sort. High was about 853, low was about 750, and is already back above 800 as we speak. PG Electroplast is up 10.5%. We highlighted that earlier. And that's, of course, come off the highs, though, but still up. Chennai Petro is up 6%. That's a decent pop coming through there. Deepak Fertilizer is up 5%. Granules is up about 5%. These are all individual names. Webel Solar is up 5%. There is GMDC, which is up 5%. Shakti Pumps is up 5%. Shakti Pumps was up 5% yesterday as well. Almost back at 5,000 rupees, Shakti Pumps. And MRPL, the other refiner, standalone refiner. So Chennai Petro and MRPL, both 5% and 4% respectively, with very, very strong market breadth at this stage. Vari is the biggest volume-led loser. Honasa, though, has picked up from the lows. The low today is 242. Stocks at about 255 right now. IGL and MGL are still sulking, but it's a half a percent, 0.75% after the 10% plus knocks that we saw on both these names in trade yesterday. Andrew, it's a pleasure. Thank you very much for joining us. Great speaking with you here on CNBC-TV18 as always. Thanks very much. We'll speak again. Nigel.
All right. Let's get straight to our next management. IRB Infra Trust to offer 5 of its matured highway assets to IRB InvIT Fund. The proceeds will be utilized to capitalize on the upcoming opportunities To help us out with the rationale, how are things shaping up, we're joined by Mr. Maheskar, the Chairman and Managing Director of IRB. Hi, Mr. Maheskar. Good morning and good to see you in. It's been a while since we chatted. This is Nigel on this side. Well, give us the rationale for this particular move and how does it help the company?
Very good morning, Nigel. Yes, you're right. We are speaking after a long time. And let me start by congratulating you on completing 25 years. We crossed that benchmark last year and happy to connect. As regards the asset that are being offered to the public InvIT, we have talked about asset rotation some time back. And IRB, I can say, has come a full circle. We have now grown the portfolio to a significant size. If we look at the IRB portfolio across the listed entity and the two downstream investments that we hold in the private InvIT and public InvIT together, it has surpassed 80,000 crores. And with this significant sizing up of the assets, we have now decided that we want to undertake an asset rotation plan under which presently we have offered 5 of our assets from the private InvIT portfolio to be sold down to the public InvIT. A non-binding offer has been made, as has been made public, and the public InvIT would now evaluate these assets on whether they would like to buy it or not, and then the process would be taken forward. The total enterprise value of these 5 assets is around 16,000 plus crores. The idea here is that with a considerable size of portfolio having created, we want to unlock some value, and the value that gets unlocked we deploy in growing this portfolio further by undertaking newer projects. And that is the rationale behind this strategy.
Mr. Maheskar, hi, good morning. Prashant here. So could you talk to us a little bit about the sort of value creation, the value unlocking that you're talking about, and where exactly will this be reinvested, the proceeds?
Yeah, so these 5 assets presently are in the balance sheet of the private InvIT. Private InvIT, as you know, comprises of 3 large investors, with IRB holding 51% of it. And GIC Singapore holds 25%, and Ferrovial Group, listed out of US, holds the balance 24%. So this private InvIT is making these 5 assets available to the public InvIT now. The enterprise value of these 5 assets, as I said, would be in the range of around 16,000 crores. The private InvIT as a portfolio has a net debt to equity of around 40% debt. So once these assets are sold, the equity value that would come back to the private InvIT will then be deployed to undertake newer projects, because we see a strong pipeline of asset monetization that NHAI or Road Ministry is likely to undertake. And that is the opportunity in future where the proceeds of this asset sale will be utilized. So let us look at it this way, that these are all matured assets, and if we see, these have been operational for last 5-6 years. So we usually bid assets on a equity IRR of 15-16%. And with the construction risk taken off, the assets having stabilized, I have a good track record on tolling revenue history, now are being made available to the public InvIT. And the rationale for public InvIT is to look for matured, stabilized assets. So with the yield compression that will come through, it will create a significant amount of equity value for the private InvIT as a part of this strategy to sell down.
Take that point. Two-part question then in that case. One, where is the plan to reinvest these proceeds? You said that the 16,000 crore you would invest in a lot of these NHAI sort of bids that are coming by right now. Awarding activity also, because the election is expected to be a little slow. So to that extent, over how long will you invest these 16,000 crores in? And have you identified any assets here?
So 16,000 crores would be the enterprise value of these assets. The equity unlockment will be commensurate to that. And the equity money that will come back to IRB, private InvIT, will be then deployed for the newer assets. So if we look at the opportunities available, TOT is a platform which government has talked about very aggressively. They have a strong plan to monetize their assets. And these are the opportunities where we'll look to bid on. And we feel that this opportunity will continue to look strong in the future as well. So if you look at it regulatorily, we expect around 5 to 6 months for this whole unlocking exercise to take place. And once we have the money in the private InvIT, if we go by the regulation, we have a holding period of 18 months within which we have to deploy this equity back into new projects. So we have a fairly long period over which we can hold this liquidity and judiciously deploy it in good assets to create further yield generation and create value for the private InvIT platform.
All right, Mr. Maiskar, a quick word on the toll collections. How have they been so far, if you could tell us that? And since we have you, we are set for the Maharashtra elections and you have presence out here. And over the last many years, there have been numerous times that we have called and asked you what could the impact be with regard to continuity or a change in government on your business. I think in the past you've told us that now you're reasonably protected, but a comment on that as well. So toll collections as well as a comment on this.
So toll collections continue to be very strong. We have been disclosing the toll numbers across our assets on a monthly basis, and we have seen excellent traction in the past so many months. That I believe is a pulse of the economy because these are projects spread across the country, and the toll numbers are very vibrant, and we expect them to continue to grow in a strong manner. And this is what gives the visibility to the whole portfolio, because if you look at the average life of the portfolio is today 22 years plus, and these assets have been growing at a very, very good pace and are creating significant value for the whole portfolio. And mind you well that IRB holds 51% in the private InvIT and also 16% in the public InvIT. So these investments, what we have done in these platforms is creating significant value, which should now start reflecting in the IRB end, as well as we complete a significant transaction where Centra Ferrovial Group bought 24% from GIC and has established a fair value construct for us to look at valuing these assets as well at IRB end. And I think this is going to play out very, very strong in the coming months and quarters.
All right, take that point.
On the election, I don't have any comment.
Go ahead.
On the election, I don't have any comment because in my experience of 30 plus years, I would say that across the governments and political parties, there has been a very, very steady regime on the policy as regards toll roads are concerned. And we are grateful to the governments across board that they have been investor friendly, and the toll roads across government regimes has done well.
So that risk is a thing of the past. It is a perceived risk.
I don't think it is a risk today.
It's a perceived risk. It's not
a
actual
perceived risk. No, not to my experience in the last 30 years.
Always good speaking to you, Mr. Maiskar. Thanks a lot for joining in. All the best with regard to business, entire rejig that we're doing. And in fact, we'll touch base say in the next month or so to understand how things are shaping up.
He's given a very political,
thank you so much for having me here.
Politically correct answer given by Mr. Maiskar out here. We, hope for the business to continue extremely well. But, speaking about roads and tolls, let's move on to cars and petrol. Perhaps Hyundai Motor India, the company that recently listed, but we know for a very long time as well, reported their second quarter earnings, Red Sea crisis affecting both revenue and margin. To talk us through the performance, now we're joined by Tarun Garg, who's the whole-time director and chief operating officer of Hyundai Motor India. Thanks a lot, Mr. Garg, for joining in. In the second quarter, we saw a decline both year-on-year and quarter-on-quarter. You did speak about the Red Sea crisis impacting certain section of your exports business, and the domestic business, of course, had a high base as well. The question then, from here on, how do you expect growth to pan out in the remainder of this fiscal?
If you see the earnings, one is the H1 earnings, where you see the EBITDA is at a very strong 13.1% as compared to 12.6% of financial year 23-24. So you can see very strong results despite the strong headwinds which we are seeing in the market. Of course, so that is very good. Regarding the Red Sea crisis, of course, it affected our exports to the Middle East. We try to really make it up by focusing on the other markets, whether it was Africa, that is one. The second is the overall volume impact was kind of made up by our premiumization strategy, which has really helped us to increase the domestic ASP consistently. And of course, whether it is the ADAS, whether it is the sunroof, whether it is the automatics, I think that continuous focus on premiumization remains. The SUV percentage has reached a 68% January to October, as against about 60% last year. So I think that focus again remains very strong. We have just launched the Alcazar facelift, which has received some great response. So I think that should add to the not only to the ASP but to the SUV percentage as well as to the margins. And of course, going forward, we are going to launch the Creta EV in the next quarter, which we believe is going to be a very strong game changer, not only for Hyundai but for the Indian four-wheeler electric space as well. So I think despite some of those demand headwinds which this year is facing because of a very high base of last year, we believe that Hyundai will continuously, make efforts to, to have some stable, results.
All right, hi sir, morning, good to see you. Ben, one more question on growth. Industry bodies, some of your competitors, they are talking about low single-digit growth for FY25. What's the growth range that you are looking at?
No, if you see the CAGR for the auto industry, it has been 5%, whether it is a 5-year CAGR or a 10-year CAGR. In fact, all the OEM players, beginning of this calendar, we have sat together to determine what kind of a growth this year can have on that high base. And all of us unifiedly, we said that it would be a low single-digit growth. And I think we have been proved right. If you see this year, we are at a low single-digit growth. But I think the important thing is that we are talking about a very high base of 22% growth in 23 and in 22, and then again a 8.5% growth in 23. So obviously on that high base, if you have a single-digit growth, this is very good. So I believe that the festival season was very good in terms of retail sales. We had a very strong Vahan registration growth in October 24 over October 23. The momentum is continuing in November post-festival as well. So we believe that, yes, once the industry stocks are normalized and, we will start seeing those positive offshoots of demand. And of course, we still remain committed to a low single-digit growth as far as the industry volumes or HMI is concerned.
All right, got that. Tarun, you've spoken in the past about the Creta EV launch, which is scheduled for the fourth quarter of this financial year. Just wanted to also know the launch timeline for the other 3 electric vehicles that you've spoken about in the past. If you can provide us with that timeline.
It's very difficult to really give you the exact timings, but we will. I believe EVs is the way to go, and we are very much committed to not only launch new products but also give a very comprehensive solution to the customers in terms of the entire life cycle. I think that is what will really differentiate Hyundai from the others. We are a very strong brand, and when the customer is buying an EV, the key areas in his mind are the cost of ownership, the service network, the charging infrastructure, the reliability of the brand, and we believe that we have everything. And of course, with HMC's technology, leadership in the EV space, I think we should be able to really provide some very comprehensive solutions to the customers going forward in the EV space.
Right. Mr. Garg, you've been focusing on premiumization. We see that the contribution of SUV has increased to 60%. So the question is that how much better, more can it get? Can it increase even further? Or you are now looking at the entry-level segment as well? If you could give us the strategy for premiumization versus entry-level and the penetration of, SUVs, which is now about 60%.
Every year we are asked this question that, is this the peak? Last year, when we reached 60% SUV contribution, we were asked, is this the peak? Now we reached 68%. And again, you're asking, we saw 70% penetration in September. We have just launched the Alcazar facelift. We are going to launch the Creta EV. So the dual cylinder is in the Exter is helping us to increase volumes there as well. So we believe that there is still more headroom as far as the SUVization continues. At the same time, we are a complete player. We are very strong in the hatches. We are very strong in the sedans. The Aura continues to do well. From a volume of 3.5 to 4,000 per month, we are now consistently clocking 4,500 and more in Aura. The Verna, after the full model change of the Verna in 2023, it has received some great response from the customers. So I think we have all kinds of powertrains: petrol, CNG, diesel, electric, a turbo, and of course, all kind of body types, whether it is hatches, sedans, and SUVs. This makes us a complete, vehicle manufacturer. Also, if you see in India, different states behave differently to different power types, powertrains. So if you see in, for example, Uttar Pradesh or Maharashtra, CNG is very much preferred. In Delhi, petrol is very much preferred. In Telangana, Punjab, diesel is very much preferred. So having different type of powertrains help us to really tackle all the customers very well in different states. At the same time, it is a very strong risk hedging. You mentioned about sometimes, maybe the allocation of gas, sometimes the prices could change, the customer preferences could change. If you have access to all kinds of technologies, I think this really puts us in a much more advantageous position to really leverage all the opportunities that exist in the market.
Let's talk a little bit about your capex plans then, with respect to Pune as well as the Tamil Nadu units.
Pune plant is absolutely on track, and in the Q3 of financial 25-26, the Pune plant will be up and running. Pune plant will add 170,000 capacity in phase 1 to our existing capacity of 824,000. So total capacity by the Q3 of financial 25-26 will be 994,000, which will take care of our export as well as domestic needs going forward. Regarding capex, we have an MOU with the Maharashtra government for 6,000 crores, which covers both the phase 1 and phase 2. Phase 2 will happen in 2028, which will add 80,000 capacity and take our capacity to almost 1.1 million. Regarding Tamil Nadu, 26,000 crore MOU has been signed till 2032. So I think everything is on track, and we believe that the Pune plant capacity addition will really give us a very strong leverage to look at not only increasing volumes, market share, but also, of course, expanding the margins as more and more models get introduced and as the capacities increase.
Tarun, there's a fair bit about hybrid and EVs. What we understand also is that you've been working on a project related to hydrogen, and you've even collaborated with IIT Madras for the same. If you can give us any details, where is that project at, what stage?
So look, what is very important is that we have a very strong, enablers in place. So we are really investing not only in electric vehicles or the charging infrastructure. In hydrogen, we believe hydrogen could be a very important game changer in terms of energy needs for the country. So we have a collaboration with IIT Madras and the Tamil Nadu government. We have committed 100 crores to the project. We are developing a hub, innovation hub, where we will try to really bring down the cost of green hydrogen from the current level of $5 a kg to probably $2 a kg.
All right, Mr. Garg, thank you so much for joining in and giving us an outlook for the second half of this year. You seemed fairly optimistic. The stock price is reflecting that, up around 1.5%. But what's actually doing extremely well in the entire market itself. The Nifty's moved closer towards that 23,700 mark itself at the high point of trade, being led by a bunch of sectors. Any of the sectors, if you look at right now, most of the sectoral indices at the high point of trade. The Nifty Bank up almost 0.75% as well. The Nifty IT index up 1.5% after having fallen 2% yesterday. The broader markets as well can't take your eyes off that. 2,000 stocks in the green for about 260 in the red.
It reminds me when Saurav as well as Sachin both fired right at the top. You have Reliance and HDFC Bank. Both of them are up close to 100%. The problem has been that both of them haven't been moving in unison. But currently, both of them are up close to 100%. That helps our cause. We're talking about more than 20% of the index moving in the same direction. So that's good news, I think, for starters.
I think, Nigel, it's a definition of age, right? When Prashant talks, he'll be talking about some of the other players. Both of us talk about Saurav and Sachin. Maybe the current generation speaks about Virat, Rohit. The generation after that, Sanju Samson and Rinku Singh, all of them.
Sunny Gavaskar.
We won't talk about age here. We'll take a quick commercial break here. We're going to come back and, we'll talk about what else, but politics, right? Because tomorrow is the Maharashtra polls. Exit polls come out tomorrow evening as well. 23rd is the counting. We have Sanjeev Srivastava and Sudhir Suryavanshi joining in to talk about what are the sort of permutation combinations and who's ahead and who's behind. So that's coming up in just a bit. Okay, welcome back. You've got the market, which of course, as we pointed out, is seemingly very, very strong. Just under 200-point gain now. It's about 40, 50-odd point give back from the day's high, but holding on strong so far. Now, the high voltage election campaign here in Maharashtra is drawn to a close. All 288 constituencies will vote tomorrow. And that's the reason why we have a market holiday as well. But let's just talk about this in some detail. Sanjeev Srivastava, senior journalist, and Sudhir Suryavanshi, senior assistant editor at New Indian Express, are with us to take us through, the permutations and combinations now, and of course, what is likely post, the votes are counted, which is not very far away. 23rd is the counting of votes. Gentlemen, good morning. Prashant here. I mean, if there was ever I dare say, a khichdi, I mean, this is it. For the life of me, I can't figure it out. So let me throw it to you, Sanjeev. Who's ahead, in your opinion, and who's likely to form the next government?
I don't think anybody knows the answer, Prashant, to that. Now you can discuss different. Two things I agree with. One, whether it's a khichdi, biryani, jeera pulao, where it's a very, very messy election. It's very complicated because the number of candidates also on each seats. Both the alliances have put on so many candidates on each seat just to cut some votes. And if it's a closed election, those factors will come to play a role. The second thing which we must remember is that whenever an election is held in an assembly state, a few months after or less than a year after the Lok Sabha elections, usually that pattern gets repeated, which gives the opposition alliance, the Pawar, Uddhav, Congress grouping an edge. But this election has become too close, and like you said, Prashant, the real game, if the election is close, may actually start post the counting. Because nobody is, except for the BJP and Congress, you can't claim with any degree of certainty that these people are going to stay where they are. So what happens post-elections will be as interesting if the election becomes a close contest, if the results indicate a kind of anything is possible scenario. So sorry for confusing the viewers and you, and because I think everybody is just waiting for the coin to fall and then see whether it's heads, tails, or what is the outcome.
I mean, that is not the ideal situation, right? From a voter perspective, I mean, you vote for somebody, and then, I mean, you don't know, which side your vote gets counted in. But yeah, you're right, absolutely right. And I don't think you confuse the issue any more than it is already. So I won't ask you like I do for not doing a straw poll in that sense. Sudhir, if you want to come in, your thoughts on who's ahead, if you have a sense.
See, I travel, almost across the Maharashtra, different part of the Maharashtra, and the sense from the ground I get particularly, in a couple of things we need to, talk or demystify the whatever you call it as a khichdi. We need to demystify it. First thing, there is an anti-incumbency factor. That is true. On the ground, there is anti-incumbency factor. Second, there is aggregate crisis like a soybean and cotton. Issues are most talked about, particularly in Marathwada, Vidarbha, North Maharashtra, and some part of Western Maharashtra, because both are major crop in this region, and both crop prices and rates has gone below the MSP. So there is anger among the farmer community. So therefore, this anger is overshadowing the Ladli Bahina scheme that government has started, to reap the benefit in the election. That is the second. Third thing, there is also an anger among the people that the parties were broken, then the government was toppled. But other hand, if you see in the Mahayuti, the benefit for them is that their candidates are very much strong, and they are not easily to dismantle by the oppositions, because they got their own popularity, plus they got money, muscle, power, plus they got an institutional network through their cooperative sector like sugar factories, milk federation. Then their institutional network like education institution, medical colleges, then many institutions. So these are both are things are holding them back and rooting them strong against the oppositions. So therefore, I will call it a neck and neck fight. And the plus, the person will manage election very well, because this is all about the micromanagement. First time I saw this election like ultra local or ultra, like a village panchayat elections. Many caste combinations, many small group. Within a caste, there is a subcaste, discussions happening on the ground. So the communities has been divided on the line of caste, then the religion, many things. So which factor will play the role? That is very difficult to, tell the viewers. But certainly I can see, the numbers will be very sticky this side or that side, and the independents likely to spell the spoil, particularly Vanchit Bahujan Agadi and the MIM for the, Mahavikas Agadi. And the other side, MNS Raj Thakre, he has also filtered 140 something odd candidates. And these candidates are on the ground. I saw they are damaging the Eknath Shinde in a big way, because Shinde and the Thakre and the BJP, they share the same kind of vote bank. So there are many issues, what I saw on the ground. But what I feel that the voter are wise, they are very shrewd, and they will give the clear mandate this side or that side, and that will be better for the Maharashtra, which has been struggling, to come out. Because if you see the growth of the Maharashtra has staggered recently in the report, as Vishal also mentioned.
Right. Sudhir, but welcome to the show. This is Nigel on this side, but you have to put a finger on it. As of now, who has the momentum going for it? It appeared that, the UBT Congress as well as the Sharad Pawar fraction, they did fairly well in the Lok Sabha elections. But do you think, the BJP-led, BJP and the Shinde camp, they have pulled the momentum back in the recent past?
Yes, in the Lok Sabha, if you see the Mahavikas Agadi has got a 63%, the space, electoral space, and the Mahayuti has got 35% only. But in the meanwhile, the Mahavikas Agadi, they took the voters and the people of Maharashtra granted and laid back, and they wasted huge time in the seat sharing and the seat allocation. I think they have made major blunders in the seat sharing and put in the candidates, and these candidates are not performing well on the ground. That is the first thing. Second thing, if you see, reason-wise, because Maharashtra is like Europe, state within the state. What Vidarbha thinks, that is not necessary that, coastal, Konkan, that is a coastal area will think. But I feel after traveling extensively on the ground, in Vidarbha, that is divided into two divisions, like Amravati division and Nagpur division, slightly give the yes to the Mahavikas Agadi, because their DMK and AIDMK combination, that is called the Dalit, Muslim and Adivasi, plus, Kunbi, that these are the major factor in the Vidarbha region. If you come to the Marathwada, in Marathwada, MMD factor is working, that is a Maratha, Muslim and Dalit. And because of Jarange, Maratha reservation agitation, the MMD factor is still intact for the Mahavikas Agadi. There is little bit desertation in the Dalit votes, but the Muslims and Maratha consolidately standing with the Mahavikas Agadi, therefore they have got the age. But if you come to the Western Maharashtra, Konkan and the Mumbai, I think that there is a 50-50. There is a neck and neck fight between the Mahayuti and Mahavikas Agadi.
All right, we take that point, Sudhir. Thank you so much for joining in. We'll give the final word to Sanjeev. Sanjeev, you said that everyone will wait for the coin to drop thereafter, call for heads or tails. But while the coin is in the air, there are a lot of murmurs around the Ladki Bahini scheme actually being a bit of a game changer. With your ear to the ground, what have you heard, and how much could that tilt in favor of the Mahayuti?
So Ladli Behna scheme has been a big changer for the Mahayuti, as well as a big game changer for Shinde's personal popularity and image as well. Nobody expected Shinde to be some kind of a big factor in this election, but he has become. But if one has to really stick one's neck out, we traveled extensively during the Lok Sabha elections in Maharashtra. And the picture, really the national picture became very clear thanks to our travels in Maharashtra, where one could sense the anger. Now in elections, we often say that the same bullet doesn't get fired twice. So will that anger sustain in the assembly elections also? It's we don't know the answer, but I think it will sustain. It will not go away entirely. Some semblance of it will remain because it's only 5-6 months since the Lok Sabha election. So if I have to really stick my neck out, I will say Mahavikas Aghadi is in the lead as of now. They should get more seats and more numbers than the Mahayuti. But that doesn't necessarily mean that they will form the government. The government may still be formed by someone else. So the real game, unless Mahavikas Aghadi really takes a clear lead, I don't see Mahayuti taking a clear lead. It's only the opposition which can take a clear jump or lead, according to me. Unless they do that, then the coin will know which side it is going once it comes and hits the ground after 23rd. Close election, Mahavikas Aghadi, traditional parameters, if you look into it, has an edge. But is it a distinct one? We don't know.
And you need a distinct one to be absolutely sure that, the one with greater seats will form the government. Unpredictable election, but I think the only thing even more unpredictable, or I don't know, I don't want to say unreliable, are exit polls, which we will get tomorrow.
Yeah.
And
so exit polls now, Prashant, sorry to say, they have become some kind of a, well, I also don't want to call them a joke. But it has become totally unreliable.
And that's tomorrow evening. And, markets will be trading. So we get the polls tomorrow evening. You'll have 2 days of trading, Thursday, Friday, and then on Saturday you have the counting.
So my question to you, Prashant, will markets react to exit polls?
They shouldn't, right? As we are saying, as I said, look at what happened in Lok Sabha elections, right? Exit polls came that weekend. Yes. Monday markets jumped. The actual results came on Tuesday. Complete reversal.
But Haryana proved them so wrong. Lok Sabha was so wrong. So the markets would discount the exit polls.
Even the US elections are wrong.
US.
There as well, the pollsters got it wrong.
So, I think, I think the markets will discount and wait for the actual results. But in any case, as both of you said, it's going to be, in that sense, Sudhir did say perhaps they will, voters will put one side clearly in the lead. We'll see. But you're saying it's going to be closer. It's not going to be that big a sort of difference. So we'll have to wait and watch. And we'll probably chat once again on Thursday morning once we have those exit poll results. Thank you very much, Sanjeev and Sudhir, for joining us here with that perspective. Thanks indeed. Well, I think 200 points higher on the Nifty, 235, 23,688. We'll take a break. We put the focus on commodities. Manisha is going to be with us on the other side. Stay tuned. Okay, welcome back. Let's look at commodities and what they're doing. Manisha is standing by. Remember, overnight, oil went up sharply. Gold prices went up about 2%. Manisha, what's top of mind?
Well, yes, crude was up 3%. You had gold prices up 2%. Silver gained up by 3%. And the base metal prices were anywhere between 1 to 3% on the higher side as well. But the best of fundamentals within the base metal prices seems to be coming in from aluminum. For the year, we've seen 10% of gains. But when you look at the year-on-year basis, you can see it has outperformed the base metal prices. The next best gainer comes in from zinc, and copper is up 8% in the last 1 year. But 16.5% of gains is what we are working with in sense of aluminum there. And there are various supportive factors coming in for aluminum. One, the generic one is that the dollar index the rally has seen a bit of a pause. Last week, dollar index gained up by 1.6%, but it's trading quite flat in the Asian markets right now. The second has been over the weekend, where China cancelled 13% tax rebate on aluminum effective December 2024. That is already baked into the prices as of now. The other factor also is about the new infrastructure demand investment in China. The first 10 months of this year show an increase of around 4.3%, and aluminum usage within that also has been on the stronger side. And then it has to do with the firm alumina prices. Remember, we've been telling you on how the bauxite supply disruptions in Guinea and Brazil have taken the aluminum prices near record highs in last few months there. Then the energy transition demand also is on the stronger side from sectors like solar panels, vehicles, etc. So when you look at the aluminum for energy transition, there's a very important report that's coming out from Norsk Hydro, which is the biggest one when it comes to aluminum production in Europe. It says that 15 to 22 million tons of extra usage in sense of EVs is what will come in from aluminum. And by 2050, this number could actually double up by 25 to 42 million tons as well. Another very important thing to note is that even as we talk about aluminum within India and globally, but when it comes to China, 63.5% of global aluminum is consumed within China. So that's a market to watch out for. And those numbers will tell you the story, because in 2015, if the world was using 27 million tons of aluminum, China was using 29. And fast forward to 2024, the world is using 29 million tons of aluminum, while China is using 43. So this is nearly 63% of world aluminum going in for China. The other thing is about prices, where we have seen good gains, as I told you. And while we are trading at around $2,600 a ton right now, the all-time high is $4,100, and we are far away from those kind of levels. Well, the markets also are looking at new capacity expectation coming in from India, Indonesia, and China as well. And that perhaps could keep the prices in check. So nobody is expecting aluminum prices to go near those all-time highs there. Importantly, on what the markets are expecting in sense of prices for next year, well, we have BMI telling us that 2450 is what they expect in sense of prices. Goldman Sachs has it at 2,700, and most bullish of them all is Citi, $3,000 a ton of a possibility for aluminum for next year.
Manisha, thank you very much for that. Keep an eye out on those prices and those commodities as well. Time for a quick commercial break. Here is The Economy. Lata in conversation with Pranjal Bhandari, Abhishek Upadhyay, as they decode trends from the second quarter earnings season, which is just wrapped up. Stay tuned.